Now, let's look at the different ways in which the global bond market can be classified. So, we can look at the classification by issuer type, right? We have government bonds, we have corporate bonds, and again in corporate bonds, we can subdivide into the bonds that are issued by financial corporations and the ones that are issued by non-financial ones. We can talk about securitized bonds, wherein a special purpose vehicle comes into a picture and the bonds are issued through the special purpose vehicle. So, some kinds of bonds like mortgage backed securities, asset backed securities falling under the category of securitized bonds. So, different kinds of issuers can very well create different kinds of bonds. So, whenever we are looking at the global market, we can categorize the entire global market based on the type of the issuer. Similarly, we can think of doing the classification based on credit quality. We should understand here that every bond is actually rated by a credit rating agency. Every issue is rated by a credit rating agency. Probably S&P and Moody's are more and more popular in the United States. Similarly, they are popular across the world itself. But of course, we do have some country-specific credit rating agencies also operating in some countries. But whatever is the mechanism, every bond issue is given a kind of a credit rating. When I look at it from an S&P's perspective, triple A is the kind of a rating which carries a highest credit quality, right? Triple A is carrying the highest credit quality, followed by double A, then A, then we are talking about triple B, double B. So anything that is above this is categorized as an investment grade bond, and anything that is below this, which is below this means there could be a B, there could be a triple C. So any kind of a rating that is below the double B kind of a rating, double B and below double B kind of ratings, we are classifying it as a speculative grade. So in some cases, the speculation grade is also called as a junk bond, or also otherwise called as high yield bond. So we can very well classify the overall market based on the investment grade bonds versus the speculative or junk bonds. And what we typically observe is some companies, while they are allowed to invest in speculative bonds, some companies do have very strict restrictions, either because of the regulators or self-imposed. Let's say an insurance companies or banks, they generally think twice before they invest in speculative or junk bond. So they are prohibited for some organizations for investment. So the overall market is classified based on the credit quality of the bonds issued. There could be a different dimension to the classification based on the maturity period of the issue itself. While some bonds can be issued for lesser than a 1 year, typically classified as money market securities, but the ones that are issued for anything more than 1 year, we classify them as a part of capital market securities. So the overall bond market can be categorized based on the maturity period. But the other way to look at coupon based, depending on whether the coupon is fixed and specified in terms of percentage to the par value as a part of the bond indenture itself, or is it floating? When I am saying floating, we know that it could be based on a reference rate, either a LIBOR or Euribor or any kind of lending rate, any kind of a reference rate which keeps changing with time. That is being taken as the reference rate, and if possible, a margin is added on the top of that, and that is what determines the floating coupon. Generally, a lot of financial firms, let's say, whose liabilities are floating, means they have to make the payments on a floating rate basis. They prefer their assets also, where they are investing, they prefer their investments also, the returns to come on a floating rate basis itself, so that the volatility of the assets and the liability mismatch can very well be reduced. So they prefer investing in floating rate, especially if their floating rate liabilities are higher, so that even if the interest rates increase because of the floating rate liabilities, the value of the liabilities is not falling down, but the value of the assets is falling down. The present value of the fixed assets will fall down, but floating liabilities may not fall. That's the reason the financial institutions which have floating rate liabilities, they prefer their assets, which is the investments, also to be primarily on a floating basis itself. So across the world, we can very well classify the securities based on the coupon structures as well. Now, if you see here, whatever is the type of classification, they are suited. Some of them are suited for some kind of investors, especially when I look at fixed coupon bond. Someone who is not willing to take any kind of a risk and is ready to sacrifice his return for the additional risk, those kind of investors typically prefer a fixed rate coupon structure itself. Whereas someone who is willing to take a risk, want to increase their coupons with the interest rate increase, and they are ready to forego their coupon even if the interest rate goes down, they are preferring for a floating rate. So, and someone who wants the returns within 1 year, they specify, they typically are the participants for money market transactions. Someone looking forward for beyond 1 year, they are more and more game for capital market kind of investments. More risk-taking investors look at speculative or junk, whereas less risk-taking kind of investors. Here, when I'm saying investors, need not be individual investors alone. I could very well talk about institutional investors as well. So the credit quality, investment grade indicates a less risk-taking structure. So all the investors who are willing to avoid the risk, they choose investment grade securities. Someone who is the risk-taking kind of investors, they are more and more preferring for the speculative grade or a junk grade. The same risk, the same kind of a classification of the investors can go based on the issuer type also. Normally, the government bonds are treated to be less risky because government hardly defaults on its borrowings. Whereas corporate, yes, some corporate may not default at all, but for some corporate, if their operations are not financially sound, they can very well default on their commitments towards interest and principal repayments. So again, the investor who is more risk taking may prefer corporate kind of bond, because generally what we observe is high risky securities typically have to give higher yields to compensate the investor for the additional risk that he or she or the company is taking. So this is one classification which we look at. Then there could be a couple of other classifications of the bond markets across the world based on the currency, dollar denominated bond markets or yen denominated bond markets. So again, based on the currency, there is a different classification. Or I can talk about the geographic location. We have already discussed a little bit about these three categories of bonds: the domestic bonds, especially if I'm talking about US as the domestic country, then a US incorporated firm issuing bonds in US denominated in dollars, we call them as domestic. Whereas if I am talking about an Indian incorporated firm, non-US firm, issuing bonds in US, issued in dollars, they are called as foreign bonds. And typically, any company, let's say a US incorporated company, issuing bonds elsewhere, US company issuing bonds elsewhere and any currency, obviously these two not being the same, right? If these two are the same, then it becomes a foreign bond. So these two not being the same, I classify them as euro bonds. So this kind of a classification can very well exist in the different kinds of bonds. Then one more broader classification I could see with respect to the bonds is again on the geographic structure itself is the bonds issued in the emerging markets versus developed markets. What are these emerging markets? Especially those kind of countries whose capital markets are not fully established. They are not fully efficient. Capital markets are not fully efficient, not fully established. We call those kind of markets as emerging markets. They are prone to higher risk, which means higher returns or higher yields should be provided for the investors who are investing in those kind of markets. So typically, developing countries, developing markets would be categorized under the emerging markets, where the potential for earning profits would be much higher, but along with the same time, the risk also would be much higher. Whereas on the other side, if I look at a developed market, the risk is much lesser, and hence the yields associated with the investment in those markets is also much lesser. Then another broader classification I can look at with respect to the interest, with respect to the bonds, is the index linked bonds. So sometimes the linking could be with respect to an inflation index like consumer price inflation, consumer price index, or a wholesale price index, or it could be something linked to an equity index or a commodity index. Any kind of published index based bonds could very well be created. But what we typically see is majority of these kind of index linked bonds are issued by the government, though even a private corporation generally which is having a very high credit quality, which is financially more and more sound, can also very well issue these kind of index linked securities. And there could be one more classification based on tax status. There are some bonds which are issued, let's say, by government or any corporate, which have that flexibility of being exempted from income tax, whereas some of them or majority of them, the interest is typically taxed as income tax. So the bonds which are typically exempted from income tax, they carry lesser yields because one, their risk is much lesser and there is no loss of income after tax. So of generally the yield that is associated with tax exempt securities, right? The tax exempt securities, whatever is the yield, I should try to compare it with the yield that is coming on taxable securities or taxable bonds. Whatever is the yield, I take 1 minus t of it to finally compare which of these two kinds of bonds are more and more preferable. So this is one more kind of classification that we see with respect to the bonds in the global market. So a simple way to put it up is the bonds across the world, they can be classified based on various dimensions like this. So those many variants of products are there, which means if someone has to really create an index based on the bonds, any of these any of these or any combination of these can be clubbed together to create a bond index. That is what will make the composition of the bond index more and more complicated. Sometimes the bond index can be created based on the geographies. Sometimes it could be created based on the credit ratings or a combination of geography and credit ratings. So a typical index, which is a representation of the entire market, can very well be created using a few or many types of classifications of the bonds. One important thing in this context is, especially when we are working out with the floating rate, across the world, there is a lot of move towards using LIBOR, London Interbank Offer Rate, as a good base for the reference rate. So again, on the top of the LIBOR, based on the credit risk that is associated with the issuer, a variable rate or a margin is typically decided, and that is what will work out to be the floating rate coupon payment. And why is LIBOR used? There are many other alternatives. There is a Euribor, there is a MIBOR, there are various other such kind of rates that are prevailing. But London interbank offer rate is primarily used because there is a lot of voluminous, there is a lot of acceptability in the global market. It is clearly published on a daily basis. The values are published on a daily basis for different currencies. So it's just not London, so it's not pound sterling or something. This LIBOR is published for different currencies and for different maturities, generally ranging from 1 day to 1 year. So probably it can come out as a 30-day US dollar LIBOR or 90-day pound sterling based LIBOR. So we can have the different time periods and the different currencies, and these numbers are being published on a daily basis. And how are these numbers typically computed? There are 18 banks, right? The 18 banks, on a daily basis, there is a survey performed for these 18 banks. The typical interest rate which they expect on the unsecured loans. If they want to lend today to some party on an unsecured basis, what is the kind of interest rate they are expecting? For 1 day lending, what is the rate they are expecting? Let's say for a 1 week lending, what is the rate they are expecting? For a 15 day, for a 30 day, like this for various days. If they are willing to lend the excess funds, what is the rate they are expecting in this process? So each bank on a daily basis will provide what is the expected interest rate for each of these unsecured lendings. So 18 banks provide the 18 different expected rates like this. Then there is a trimming that is done. What is this trimming? The highest and the lowest values are removed from them. And out of the remaining, the average is typically taken, and based on that average, the LIBOR is published. So for each of the maturity, the same exercise is being repeated, and on a daily basis, these values are published. And from a floating rate bonds perspective, it is necessary that any bond, depending on the coupon payment, if it is a semi-annual coupon paying bond, it's better that it uses a 6-month LIBOR rate as a reference rate. If a floating rate payment is doing a payment on a quarterly basis, it's better that it uses 3-month or 90-day LIBOR as a base, the 90-day LIBOR as a base for making the floating rate payment. So that's one thing which any floating rate paying entity needs to keep in mind while using the LIBOR, because LIBOR is published for almost up to 1 year. This additional care on which LIBOR value exactly to use can be analyzed based on the frequency of the payment that is planned, right? So that is how we look at the classification of the global bond markets on a very introductory level, and along with why typically LIBOR is used, right? Now, let's look at the primary and the secondary market that is available for the bonds. Whenever we talk about the primary market, it is more to do with the sale of the newly issued securities. Whether we talk it with respect to equity or bonds, new securities being sold is what constitutes the primary market. So even in case of bonds, we are talking about selling the new bonds is what a part of the primary market. And this selling can be done, one, either to the public through the public offering process, or it can be done to a qualified set of few private investors through what is called as a private placement. So in general, whenever there is a public offering done, there is a lot of disclosures to be done, because lots of information needs to be disclosed to the public. So there is a registration with the securities regulators, and there is a lot of disclosure requirement when the company wants to issue the bonds to the public and raise capital from the public. But when we are talking about private placement, the company can directly place it with a few select set of qualified investors without registering. I'm sorry here, without registering with the securities dealer. And whatever is the mechanism, whether it is selling it to the public or placing it with a private set of individuals or qualified institutional investors, this entire process typically is done with the help of an investment bank. Investment bank is specialized in a lot of areas with respect to the primary market function. They can help the organizations who want to issue the bonds right from the first step of computing the funding needs. How much is required? What is the objective of the fund requirement? How is it going to be used? Is it for a geographical expansion, or is it for a product expansion? Whatever it is. Now, based on that, how much fund is required? And and using all that expertise, they try to structure the debt. What is the way in which the capital needs to be raised, and what could be the collaterals? What should be the credit enhancements that can be provided? So they try to create the debt structure. What should be the coupons that need to be paid? What should be the face value of each and every bond? They try to structure the entire debt security, and based on that, they even create the bond indenture. They completely create the bond indenture. Along with that, come out with the identification of the trustee for that particular bond issue, and register this issue with the securities regulator, so that it can be sold to the general public. And they determine what should be the price based on the demand and supply. And finally, they take the responsibility in terms of selling this bond to the public. Now, because they are taking the responsibility of selling this to the public, they are even taking a risk in this process. The risk is entirely lying with the investment bank itself. So that's and for that they would be charging the kind of margin that they are going to get in this kind of a transaction is much heavy, because they are taking the responsibility of getting the entire issue sold. And that is where we talk about the underwritten offering. They could very well get into an underwritten offering or a best effort offering. When they are doing a best effort offering, there is no commitment, no purchase. It's primarily the advisory kind of a role. They perform the advisory kind of a role in terms of determining how many bonds to issue, what is the price of the bond, how is the debt needs to be structured, but they don't take any kind of responsibility or ownership in terms of getting the whole issue being sold. Whereas when they are talking about an underwritten offering, the investment bank primarily purchases the entire issue from the company, either as on a standalone basis or it forms a syndicate. That particular investment bank would be the lead underwriter, and along with that there could be a few other banks which could be supporting this entire process. This entire thing will form a kind of a syndicate, and this syndicate will collectively price the entire issue, and they in turn try to sell this to the dealers, and who in turn will be selling it to the different investors. So this is a typical process that happens when a primary sale of the securities is happening into the market. In some cases, there could also be a possibility wherein the trade can happen on a when issue basis in a gray market, which can help the firms in terms of identifying the demand. What is the typical demand? How many dealers are willing to typically purchase this particular bond? They can understand the demand, and based on that, what should be the market price that they need to set for this new issue before it gets launched into the market. So a gray market trading can really help the underwriters, which is the investment banks, to really come out with an assessment of the price and the quantity that could be sold based on the assessment of the demand that is getting created or generated in the gray market. So these are the common forms of underwriting that we see. I mean, these are the common forms in which the selling of the bonds happens by the investment bank, either through the underwritten offering process or through the best effort offering process. In some cases, especially the government securities, we see an auction process going on. So generally, it goes like every investor, he submits he submits the price at which he or she is willing to purchase that specific bond, and based on the quantum of bonds that need to be sold, the best possible price is decided. It need not be the highest, right? Because at the highest there could be only 20 purchasers. The next highest probably there could be 50 purchasers, and the next highest there could be 30 purchasers. So, but I still want 100 purchasers to typically purchase this particular bond. So the price would be set at this particular price, even for this person, so even for these investors and these investors. So that is where we are calling as a single price auction. And generally the major participants in the auction kind of a market are the primary dealers themselves. Even an individual investor can participate in a periodic auction, but even today we see that the volumes of participation of individual investors in the government securities market is very limited. And in some cases, the selling can happen even through the shelf registration process, wherein, let's say, the company wants to issue bonds worth these many $1 million, right? But they want to issue them in phases. Right now, they want to issue only this much and raise capital for this much. Then, after a certain point, for something more. Then, after a certain point, for something more. So, they want to do the issue whenever required. But what they do is they register this entire aggregate value in one single go with the securities registrar, and based securities regulator, and based on when required they go with issue. Because of this, the disclosure requirement at one single point, if they are going to do the disclosure, that is going to be sufficient. So the disclosure requirements at different points in time typically go down, and there is a risk involved because right at this point, probably yes, the company may be financially sound, but it might go down and down. So only for those companies which are expected to have a very stable business, which are expected to be financially sound consistently for the entire issue amount, but only for those kind of companies the regulator can typically grant this kind of a mechanism of shelf registration. The entire issue is registered in one single go, but the issue of the bonds to the public is occurring in parts. So this is where, because of the risk that is built into it, it is suggested that these kind of securities, these kind of shelf-registered products, they would be more appropriate to be sold to qualified private investors rather than to the general public. So different ways in which again the bonds can very well be sold by the companies either to the private individual qualified investors or directly to the public through the underwritten offerings of the investment bank or the best effort offering of the investment bank. But once the particular bond is issued in the primary market, after that there could be more of buy and sell between the purchasers, right? Someone who has bought it, they want to sell it off, some other person wants to buy it. So that is where the secondary market is getting created. The trading of already existing and issued securities is happening in the secondary market, while some of those kind of trades can happen on the exchanges, especially some government securities and even some corporate bonds. The trading of those can happen on the exchanges, but the volumes are very, very small. Volumes are very, very low in the exchange based secondary market, heavily dominated by the over the counter market, where the various dealers of these different bonds, they quote their bid and ask prices. Bid is the price at which the dealer wants to buy that particular security. Ask is the price at which the dealer wants to sell that. So obviously the dealer wants to buy at a lower price and he wants to sell it at a higher price. The difference between the two is what we call as the dealer spread. And the dealer spread for different kinds of bonds, it could be different, right? It can be anywhere around 10 basis points, or probably it can even go to 50 basis points or even more. So the dealer spread is completely based on the liquidity that is associated, how soon he is able to sell off the one that he has bought or buy the one that he has sold. So that is what will determine the spread, because the dealer is taking a risk in terms of buying from one party and selling it to the other party. So that is where the dealer spread keeps coming up, and that is what could contribute to the change in the dealer spread. But a majority of the bonds even today are settled through the dealer traded OTC market itself. And coming to the clearing and settlement, especially for the corporate bonds, today there is a T plus 3, which means if I have done the trading today, after 3 days, the cash is exchanged for the bond. Bond is physically delivered for the exchange of cash on T plus 3 days. For government securities, government bonds, the settlement happens in T plus 1, whereas for a lot of money market securities, the settlement happens on the same day. Generally, we find them as cash settled kind of transactions. So a secondary market primarily deals with clearing and settlement of the securities from one party to the other in exchange for cash. So that's how the primary and secondary bond markets are organized, right? Now, let me look at the different types of bond securities that are issued. We know that the bonds can be issued either by government or by quasi-government agencies or even by various corporations, right? So typically, you are trying to understand the different characteristics associated with each of these bonds. So initially, let's get started with the government-specific bonds. What are the different kinds of bonds which national government, the state governments, or for that matter any government based agencies, what are the different kinds of bond securities that are issued by them? So it goes all the way with sovereign bonds, which are generally issued by the national government, and the government can issue either a fixed bond or a floating rate coupon bond or indexed. We know floating changes with respect to some kind of reference rate, the coupon payment changes with respect to some kind of reference rate, and in case of index, the coupon could change with respect to some kind of a published index, inflation index, or consumer price index, or it could be equity index or commodity index. But generally, the ones that are issued by the national government, they are all inflation indexed kind of bonds. So the coupon could change accordingly, or even the principal amount could be adjusted for inflation. So those are the typically the sovereign bonds, and generally the repayment for this sovereign bonds is done through the taxes that are collected. So the government, if it is more and more capable of collecting the taxes comfortably on time, it means that it has the ability to make the payments for the bond investors quite comfortably. So the major way of repayment for these kind of loans is through the taxes that are collected, and in some cases it could even go to the extent of printing currency, because that's the national government whose responsibility is the whose responsibility goes for printing currency. So most of the times it is through the taxes collected, but in some cases it can even go towards the printing currency. But whatever is the mechanism, the government will take full responsibility to make the repayment. So very rare that it is going to default, right? On its borrowings, it's very rare that it is going to default, and that's the reason we say that the sovereign bonds carry a highest credit quality if they are issued in the domestic currency, because in the domestic currency or in the current country, this particular government has the capacity to collect the taxes or even print currency of the domestic country. So as long as the issue is in the domestic currency, we see that the credit quality would be much highest, and probably it's used as a proxy for risk-free rate of return. Whatever the return that comes on the sovereign bond is treated even as a proxy for the risk-free rate of return, because there is literally no risk, but some return is going to come up with these investments as well. Then, if they are issued in a foreign currency, which means uh, which means the bonds are issued not in the domestic currency. So a US company which is a domestic has issued bonds in UK. So that is where it is issuing and in pound sterling or in euro. What we typically see is this is the issue that has been happened in the foreign currency. One, this particular government does not have the authority to print this particular currency, which means they cannot the repayment is not fully guaranteed. And along with that, if I am talking about the tax collectability in this country, as even if I assume that the tax collectability in this country is very very efficient, as far as this company is as far as the government of this country is concerned, it is even more riskier because of the exchange rate risk that could be present in the transaction. So that's one of the prime reasons. The bonds that are issued in the foreign currency, they may not be as highly risk free as the bonds that are issued in the domestic currency. So which could lead to slightly higher yields that needs to be offered while issuing the bonds in a foreign currency compared to the issue in the domestic currency. Then one more important point with respect to government bonds is the most recently issued bonds for each maturity. Let's say for 1 year maturity, what is the most recent issue? For 2 years maturity, what is the most recent? For a 3 month maturity, what is the most recent issue? All these most recently issued bonds of different maturities are typically classified as on the run securities, right? And on the run securities have a lot of demand. They are the ones which are very heavily actively traded in the market, and those are the ones which are typically used as a benchmark for risk-free rate, to typically price or determine the return of other government or non-government or corporate kind of bond issues. So sovereign bonds do carry that much of weightage in the market, and there's a lot of heavy active trade for them. There are very liquid. There is a lot of volumes and market associated with these sovereign bonds, especially on the run kind of securities. Now, there could be a few bonds that are issued by non-sovereign government. Whenever the national government is not coming into picture, any kind of borrowing that is being raised by state government, by provinces, all those things will get categorized under the non-sovereign government bonds. So even a state can raise the capital through issuing bonds. Even counties can raise capital by issuing bonds. Even provinces can raise capital by issuing bond. But generally, it might be possible that they have raised that capital for a specific project. It could be the construction of some public welfare park, or it could be for providing some infrastructure facilities to the public. So the bonds could be typically issued with respect to some specific project, or in general any kind of a general welfare activity. But whatever the payment typically can come either from a specific project, the revenues that are coming out of that specific project, or in general, those state government and provinces can collect the taxes, or they may levy some special fees wherever required, and based on that, they can very well do the payment. But what we typically see is compared to the national government issued securities, they are slightly less credit quality, means bear a higher credit risk compared to them, but overall they are perceived as less risky kind of instruments only. Now, on the other hand, government agencies, some kind of entities that are created by the government for a specific purpose, right? I can talk about an agency which has been created for user identification number in India. Now that's a government agency. It is if something is created by the government exclusively for a specific purpose, we can call it as a government backed entity. In US we have agencies like Fannie Mae, Freddie Mac. These kind of agencies typically are created by the government or government sponsored enterprises for executing some specific activities like monitoring and taking care of the loan. In various countries we have different agencies, and these agencies can raise capital by issuing different bonds. In some cases they may be backed by the government, in some cases they may not be backed by the government, but whatever is the case, we see that they are also carrying a good credit rating. They also have very limited credit risk. But of course, when I compare them with sovereign bonds, the credit risk is higher in those kind of instruments as well. And sometimes even a supranational agencies or multilateral agencies like World Bank, IMFs, Asian Development Bank, these kind of agencies also raise capital in multiple currencies across the world, and these kind of bonds which are issued by such a kind of supranational agencies beyond the national government kind of agencies, we call them as supranational bonds. They carry a lot of liquidity. They are very high credit quality, especially if these kind of agencies are issuing those kind of bonds, right? So government related, there are different kinds of securities that are issued, which are carrying different levels of credit quality, different levels of maturity, and different amounts of credit risk that is built into them, and because of that, different yields are expected to be offered on those kind of securities. Now, coming to the corporate debt, which is a kind of raising capital done by the corporate, which could include financial as well as non-financial institutions. So the normal way of raising capital by these companies is through a bank debt, and in majority of the cases, the loan from the bank would be a variable, would be a floating rate kind of a loan. So whenever we are talking about a floating rate loan, there is a kind of a reference rate and a typical margin on the top of the reference rate. But along with that, there could be a variable rate also built into it, which means the banks can typically will also have the flexibility to change this margin amount depending on the credit risk that is associated with this borrowing firm. So in general, they have a combination of these two. They go with a LIBOR based. So as the LIBOR changes, the interest rate changes, and even a variable rate also is applicable on the top of it, which means even if the credit risk of the underlying company changes, the margin that is associated, which is added on the top of the reference rate, also keeps changing. So that's a typical bank loan. But what we see is this bank loan can be offered either by a single bank, in which case we call it as a bilateral debt. But in case it comes out from a pool of banks or a syndicate of banks, we call those kind of loans as syndicated bank. There will be one leading bank and all others will work together as a syndicate to typically lend for this particular organization. And wherever the lending is through a syndicate, we see that that entire loan can be packaged, right? That entire loan can be packaged, sold to an SPV, which in turn issues the bond. So which means there is a kind of a secondary market that is associated with the syndicated loans. These syndicated loans can be sold to an SPV, and who can design the instruments by selling different kinds of bonds to the various investors. So there could be a tranching that could be performed, and there are different ways in which the securitization can operate in that particular process. So that's one more advantage where illiquid asset can be converted into liquid, especially with a syndicated loan kind of a structure. And in some cases, the corporate can even issue a commercial paper, especially for the short term borrowing purposes. Right, if it wants to raise a loan for a short term purpose, generally for anything less than 270 days, it could be even from a 1 day perspective, overnight borrowing perspective, so 30 days or probably 3 months, 90 days, or even up to 270. So whatever, any kind of commercial paper that is issued primarily from a short-term perspective with a maturity of less than 270 days and unsecured, no collateral is required for those kind of purposes, They are generally exempted from SEC registration in the United States, and that is the reason the commercial paper becomes a very important instrument to be offered for raising capital. And what we see is, especially for firms which are really financially sound, for them the cost of borrowing is much lesser. The cost of borrowing through a bank, a short term borrowing done through a bank, the interest rate would be much higher than the rate that comes through a commercial paper. So it is more and more applicable to the firms which have very high credit rating only. The rate, they can very well issue a commercial paper, they can get the entire commercial paper subscribed by the participants, and they can very well get a much lesser credit rating, much lesser rate of interest compared to that of the typical bank loan for a short term. So that is one advantage that comes. But of course, whenever I compare it with respect to sovereign bonds, they bear a high credit risk because corporation compared to a government has a higher chances of defaulting, and it does not have any hold in terms of printing currency. So there is a possibility of defaulting on the payments, even though in some cases it could be much lesser, but definitely it would be a higher compared to that of a government. So the credit risk is higher, and the market, the secondary market for that also is much lesser. It's much more less liquid, which means to bear the liquidity risk and the credit risk, they need to offer a higher yield compared to that of sovereign bonds. And from the usage perspective, I see that the companies use it for working capital purposes. So working capital requirement generally would be much less than 270 days itself. The difference between the current assets and the current liabilities is what we are calling as a working capital. In some cases, it might be possible that the current liabilities could be more than the current assets, and that is where the shortage comes up, and that is what can be bridged. That is what can be that difference can very well be paid off, or those small obligations can be settled using this commercial paper. Or in some cases, the companies, before they go for a long term, let's say they are going for a long term debt, and let's assume that this long term debt is used for the purchase of the equipment, right? Some equipment, and they are going for a long term debt. Now, what could very well happen is, let's say this long term debt is taking 2 to 3 months for the entire process to be completed. So, within this 2 to 3 months period, they can purchase the equipment through this short term commercial paper, and once the commercial paper matures, let's say 3 months later, the proceeds of that can be used to pay towards this. The proceeds of this, whatever the proceeds of the long-term loan, whatever they have got, they can be used towards the payment for this commercial paper. So once the long-term loan is got, let's say 3 months down the lane, that proceeds can be used typically to pay off for this commercial paper. So here the commercial paper is issued, raised capital. This capital is used for purchasing the equipment. The commercial paper matures here. By this time, I got my long-term debt. The proceeds of the long-term debt can be used to pay off for this short-term commercial paper. So this kind of financing, where I am looking at it as a temporary source of financing, and especially before a long-term debt that is getting issued, just to cover the period and hasten the payment process or hasten the purchase process, I can use a temporary source of capital, and in that case we call it as bridge financing. And bridge financing is also done through this commercial paper. And in some cases, what could very well happen is this commercial paper, let's say, is a 90-day maturity commercial paper. Once it matures, again it is reissued. Again it is rolled over. So a rollover or a reissue is possible. Now, in general, okay, let's say the company has taken some kind of commercial, issued some kind of commercial paper and raised a capital. Here it has to make a payment, and this is where it can think of reissuing. So on one side it has to pay for the investors here, on the other side it is doing a reissue. So it can use the reissue proceeds to typically pay for the existing investors. So that is where the rollover is actually happening. And what could very well happen is this amount may not be sufficient to pay off this. Whatever is coming out of the reissue, if the reissue is not fully subscribed, or the reissue requires a very high interest rate to be paid. Why can that happen? Either because there is a general slump in the economy and overall financial system got badly impacted, like the 2008 crisis, or specific to this company, the paying capacity got deteriorated. The credit risk of the company has increased, the paying capacity of the company got deteriorated, or even there is a perception about worsening of the business for this particular company in future. All these are the drivers for this rollover risk. This amount may not be sufficient to pay off this. So this is where a shortage can come up, especially because either the new issue will not be fully subscribed, because it is expected that the company has to pay a higher rate for the new issue, because of in general the industry slump itself, or in general the economy slump itself, or more specifically this particular company's paying capacity got worsened. In those cases, to fund for this shortage during this particular process, the company can take the help of backup lines of credit with the bank. And this backup lines of credit, the bank typically gives some kind of an assurance that it would be bridging this shortfall that comes up, especially during the rollover, unless some material adverse changes occur, like the complete slump in the economy itself, or some kind of worsening of the situation of the company to a very drastic extent. In those kind of circumstances, the bank may reject. Otherwise, bank will typically provide funds for this shortfall, and that is what will bring out as a liquidity enhancement measure by the company while it has issued the commercial paper. To a large extent, we see that the commercial papers are issued on a pure discounted basis, like your treasury bills. So there is no intermediate payment, no coupon payments are happening, only the face value would be paid on maturity. And the purchase price is always lesser than the face value, because the difference is what adds up to the interest that gets paid. Whereas in general in US it goes in this way, but when I'm talking about a euro commercial paper, it can even have maturities up to 364 days, almost up to 1 year, and they don't quote on pure discount basis. For them, the yield is an add-on yield. So whatever is the purchase price, a percentage of interest is levied on the purchase price, and both are getting added up to pay the final maturity amount. So to the final maturity amount, the interest is added up and the total is paid on maturity. It's not the face value that is paid on maturity. Then a few other corporate bonds that could be issued. We know that different corporate can issue the bonds with different coupon structures, fixed, floating. They could be secured or unsecured. They may be packaged with various contingency provisions, callable, puttable, convertible, having warrants. All these kinds of provisions could be packaged. There could be a sinking fund provision as well, wherein the company may plan to retire some portion of the debt every year, and that would be specified as a part of the prospectus. But the only difference is uh, who should surrender, and the various extra options that are there, doubling option, accelerated option, they create some kind of uncertainty, especially when the interest rates are higher, right? Interest rates are higher. Probably if I am asking for the customers to surrender or the investors to surrender, not too many surrenders can happen. And in that case, the trustee has to really pick up those bonds that would be bought back on a random basis, which means the investors are uncertain in terms of when their bond is going to be retired. It might be retiring in the fifth year itself, or it may be staying up to the 10th year as well. So the investor is having some level of uncertainty with respect to what is the maturity period for his bond. So as an alternative to that sinking fund provision, there could be something called serial bond issue, which could be issued by the company itself. So just see, in case of a sinking fund provision, let's say I talk about a 10-year maturity bond, right, with a 5-year, let's say, lock-in period. And after that, let's say 20% of it is going to be retired every year until the 10th year. Let me assume that this is what is the sinking fund provision the company has created. Up to 5 years, no bond would be retired, but from 5 years onwards, 20% of the bonds would be retiring every year. And in case they are not available in the open market, the company can, the trustees can pick up those bonds on a random order, and they can very well retire them. On the other side, probably when I am talking about a serial bond issue, the company could typically plan out a few bonds with a maturity of 5 years or 6 years, few bonds with a maturity 7, few with a maturity of 8, few with a maturity of 9, and few of them with a maturity of 10 years. So overall, yes, some investors will be subscribing towards a 6-year bond, some for 7, some for 8. Now what we could typically see is it is as good as a 20% retiring. Probably for a 20% of this total face value, it can issue a 6-year bond, for 20% a 7-year, 8-year, 9-year. This acts as a perfect alternative to a sinking fund provision, but at the same time, it creates some kind of confidence in the investor. The investor is very clearly aware of the redemption date because he has subscribed to that bond, which is having a maturity of 6 years or 7 years. So the surprises are typically avoided. But of course, do we have the subscribers for all these things is always a question. So some of them may be more liquid, some of them may not be liquid at all. For some of them, the subscription may not be possible at all. So those kind of risks typically are bound to occur. But as a theoretical stuff, I can very well see that a serial bond issue is a decent alternative to a sinking fund provision. And from a corporate debt perspective, there could be different terms to maturity. In general, anything which is issued for less than 5 years, we classify it as a short term bond. Anything between 5 to 12 years of maturity, we treat it as a medium term bond, and anything above 12 years of maturity, we keep considering it as a long term bond, right? And There is another very popular bond that is issued by financial institutions. Typically, though the name is medium term notes, it has nothing to do with this definition of medium term. It can be issued anywhere between 9 months to 100 years range, and generally it is quoted with respect to the ranges. In a particular range for this kind of maturities, the particular company is willing to issue bonds, and for various maturities within this range, the yields are typically quoted. Now, whosoever is willing to invest in this, the interest is shown exhibited through an offer to the agent of the issuer. Agent will check the company's willingness and basically executes the transactions. So generally these kind of instruments are issued by financial companies, and even the buyers also are majorly the financial companies itself. We have either fixed coupon bonds to a large extent, especially if they are more and more longer term in nature, the coupon rate would be fixed. Otherwise, even a floating rate or an index rate can very well be linked with the coupon payments as well. But of course, here the participants are very few. Financial companies are the buyers and sellers. The liquidity is much lesser, especially if it is more and more customized kind of an issue. The liquidity is much lesser. So the risk is going to be much higher, which needs to be compensated with a higher yield. So, in essence, what we are typically seeing is different kinds of bonds which are issued by different kinds of organizations, sometimes government, sometimes non-government, sometimes corporate, having differences with respect to the coupon payment, with respect to the security, with respect to the backup through which the payments are typically made, the kind of collaterals, the kind of other credit enhancements that are packaged into them. All these things differentiate the world of the bonds, and the presence of even something like contingency provisions like callabilities, putabilities, convertibilities, they all create wide variations in the options that are available for the investors as far as the investments in the bonds is concerned, right? Now let's look at the different short-term funding alternatives that are available to the banks. Right, now that in the earlier session we have looked at the short-term funding or the various borrowings that are done by corporate as well as by the government. Now here I want to look at from a bank's perspective, what are the various short-term funding alternatives that are available. Now the first one, which is known to all of us, the retail deposits. So it is a regular customer deposits. So there could be a few checking accounts, there could be a few savings accounts that could be maintained by the bank. Checking accounts provide different kinds of transaction services and charge a kind of a fee from the customers. They are highly liquid because the amount is readily available for them. Whenever they want, the bank can use that typical amount, and it need not pay any kind of interest on that. So this is one kind of a service which the bank can very well provide for various transactions. The amount is readily available for the bank, and it is highly liquid. Whereas on the other side, it can even offer a few savings accounts where the regular investor, where the regular customers, they deposit their money in the banks. So transaction services are much lesser there. They are less liquid because the customer can withdraw them whenever he wants. So from the bank's perspective, they may or may not use it as a quick alternative for short-term funding, slightly lesser liquid compared to that of checking account, and at the same time the bank may have to pay a periodic interest on them, because on a quarterly basis there is a kind of an interest that is paid on the savings accounts deposits, right? Then Apart from this, the bank also can issue certificate of deposits for short-term borrowing purposes. The CDs, the certificate of deposits, can be very well issued by the bank. Again, the maturities of them would be typically less than 1 year. They are interest bearing. They are not pure discount. Alright, on one side we have seen the treasury bills, which are borrowings of the government, the commercial paper, which is the borrowings of the corporate for short term. They are generally offered on a pure discount basis. Whereas when I look at certificate of deposits, they are interest bearing. So based on the purchase price, there is an interest that is added, and this is what would be equivalent to the maturity price. So it's not the face value, that is the maturity amount. Whatever is the purchase price, and interest is added on the top of that, and that is the market price that would be typically paid on the maturity. So they are typically the interest bearing instruments. They carry a range of maturities, but typically lesser than 1 year. So it may be any time between 1 day to 1 year kind of maturities. And within that, we see two main categories. The bank can issue either a non-negotiable certificate of deposit, in which case the party who has purchased that CD, the investor in that CD, cannot sell it to any other party. So it's a non-sellable, no secondary market exists for that. Even if it is, even if the party is trying to sell the certificate of deposit back to the bank itself, which is nothing but the withdrawal, even if some kind of withdrawal is typically planned for that CD, there is a penalty in terms of the interest rate that would be awarded. So, which means a non-negotiable certificate of deposit, which works more like your fixed deposit market. One, it is non-transferable to someone, and at the same time, any kind of a withdrawal will attract a penalty. But there could be a negotiable certificate of deposit generally issued for high values, few $1 million, right? The face values are much higher. In case of negotiable certificate of deposits, there is a active secondary market for buying and selling those kind of securities, and there is a domestic secondary market, as well as the secondary market is active even in the Eurobond kind of a market. So that is one more source of financing that is available for the banks in short term. Then the other important source, which I really find it interesting, is the excess reserves borrowing. See, typically every bank, from whatever the deposits that they are getting from the customers, a portion of the deposits need to be maintained as a reserve with the central bank. Now, what could very well happen is this reserve, some banks may have excess than whatever is the reserve requirement, while some banks have it as a shortage on a day-to-day basis. Now, the general process is the banks which are having excess reserves, they try to lend that excess part which they can withdraw. That excess reserve can be lent to those firms which are having shortage reserve. So that is where one market is getting created. So if at all the bank typically wants some kind of a funding for a short term period, it can borrow from those banks which have excess reserves. So it could be just on an overnight basis, just for 1 day the borrowing could happen. This is one common form of borrowing, because for a short period there could be a shortage in terms of the fund that is the reserve that needs to be maintained. So there could be a borrowing on a 1 day basis, or probably a 15-day basis, and same way it can go up to 1 year. When it goes up to 1 year, we call that as term fund. and as long as it is less than 1 year, as long as it is a 1 day transaction, we call them as overnight fund. And the interest rate that goes from the lender to the borrower, the interest rate that is charged by the lender to the borrower, typically called as the Fed funds rate, the rate at which the interbanks do a lending and borrowing. It is purely based on how much money is available, how much reserves are available, and how much of this the banks are actually active in the active in the money market operations, open market operations, buying and selling securities, buy sell government securities, to what extent the bank is participating in terms of buying and selling government securities activities as a part of the open market operation, to what extent the interest rate is getting changed based on these open market operations and the remaining availability of the funds that are available. So the more and more funds that are available, probably the interest rate charge would be much lesser, the shortage of the funds that are available. So more of a demand and less of a supply, the interest rate are going to go up, and less of a demand, more of a supply, the interest rates are going to go down. So that phenomenon is common across. This is one more way the banks typically get into the borrowing the excess reserves of those banks, with the central bank. Then, apart from the reserve borrowing, there could be a normal borrowing process itself. The banks, one bank can very well lend to the other bank. Need not be that excess reserves. The regular lending between the banks, the unsecured loans that can be provided, which are called as the interbank fund. Again, they may have maturities from 1 day to 1 year, but of course, they are not that heavily liquid, especially during the periods of market stress when the economy is passing through a very heavy stage of recession. They become more and more less liquid. So these are the different kinds of alternatives that are available for banks in case they want some kind of a funding on a very short term basis. It could be a day, starting right from a day or an overnight kind of a requirement to even up to 1 year. And there is one more mechanism where we can talk of repurchase agreements, which is also a source of funding for short term purposes, in short called as repo. So here we are talking about, okay, if I am talking about two entities, this is the borrower, this is the lender. What typically happens in this repo agreement is some security, generally the government security or the treasury bills, this particular entity sells to this. So selling the government security here, this entity is going to provide the funds. But the selling of this security happens with a kind of a commitment that at a later date, the borrower is going to buy back that security by paying higher price. So two transactions are happening. Today, on the day of borrowing, the borrower is selling a government security or a very high credit quality security to the lender and receiving the fund. But along with that, there is a commitment that the borrower is giving to the lender that he would be repurchasing that particular security at a later date for a higher price. The higher price is already fixed at the time of selling itself, and generally it is a reflection of the interest, because this lender is providing the funds today and he would be getting the fund back at a later date. Probably the date is also specified, which means the difference is what contributes to the interest, and generally it is expressed as annualized percentage. So it's like if 100 bucks is what is provided, and 101 buck $100 is what is provided, and $101 is what is the price that needs to be paid. Let's say after a 3 months period, the commitment is to purchase back that security for 101. That extra $1 expressed as a percentage of $100 and annualized. So expressed as a percentage of $1 giving me 1%, but this is for a 3 month period, so I'll annualize it, overall resulting in 4% rate. So the 4% is what we call as the repo rate in this case. The difference is expressed as the annualized percentage, which is a reflection of the interest. And the security, whatever has been sold, generally it's a government security, that acts as a collateral. And in some cases, the security can be physically delivered here, and in some cases, some securities may not be physically delivered, but they are a reflection. They are in agreement, they are being transferred to the lender. So in some cases there is a physical delivery. Of course, when there is a physical delivery, it acts like more and more security. But when there is a kind of document based delivery, probably the security levels are slightly lesser. And even here the borrowings could be either on an overnight basis only for 1 day, or they can be called as term repos any period up to 1 year. So those kind of things can very well be existing. And what is typically observed is the interest rates that are charged on these repo agreements are much lesser compared to that of a traditional bank loans or any other short-term borrowing. Because one, whatever the security that is delivered is generally a treasury bill or any government security. The scope of default on that treasury security is much lesser. So that's the reason the overall risk is much lesser, which means the yield that is expected on such kind of instrument is also much lesser. But still, there could be some kind of haircut that is applicable. When I say haircut, okay, this party has delivered a security and has got the fund. Let's say the market value of this government security that is delivered is 102 bucks, $102. But this particular entity, this lender has actually provided the fund only for $100. The market value is $102, but the fund is provided only for $100, and the repurchase is planned, let's say, for $101 for after 1 year, after 3 months. Now, in this case, the difference between the market price of that security and the amount that is actually lent, if I am establishing it in terms of percentage of the market value, 2 divided by 102, I am expressing it as a percentage of the market value, the difference. This is what we call as the haircut that is applied, or sometimes we call it as a repo margin. That is just as a cushion. Okay, though it is 102, this person can very well lend 102. But what if after the possession the market value of this falls? If the market value of this falls, let's say to 100, this party may not be even willing to pay 101 to purchase it off. Because even after he purchases it at 101, he may not be able to sell it for more than 100. So he may not be willing to even purchase it. Because it's a collateral, he may abscond on the loan, and this collateral becomes the property of this particular lender. But the market value of that property is gone down. So it will be a loss to the lender. So to protect himself from those kind of decrease in the values, market value of the collateral that has been taken, lenders typically apply a haircut for the collateral. Any collateral that is received, any security that is received in a repo agreement, depending on the credit quality associated with it, a haircut is applied. So this haircut is applied, let's say up to this much percentage, which means the amount that would be lent will be this much lesser than the actual worth of the security. So though the worth of the security in the market is $102, the actual amount that is lent is only $100. So it is expressed in the percentage terms, and it's a good protection to the lender under the scenario where the market value of the security that is delivered actually falls during the entire repo period. Right? That's an interesting point to remember. And whenever we are talking about the repo rate, as the term is increasing, the longer the term of the repo, overnight repos, it might be cheaper, but if I am going for a 1 year repo, the interest rate would typically go up, because in all the cases, remember, it is annualized only. So it's not that the time period is lesser and hence it is going up. All of them are annualized only. But what we see is the risk is higher with the term to maturity, and that's the reason the longer is the term to maturity, the repo rates will be higher, even expressed in annualized terms. And if the other alternatives that are available, if the interest rates associated with them are higher, we'll see even the repo rates also go tip higher. And depending on the credit quality associated both with the borrower and of the collateral that is getting delivered, right? Borrower's credit quality is high, and even the worth of the collateral, the credit quality associated with the collateral, government security, if it is the collateral, obviously the credit quality is much higher. But if I am talking about a typical share of a company, the credit quality associated with it could be much lesser. So what we typically see is any instrument, any collateral which is having a very high credit quality, any borrower who is having a very high credit quality, the repo rate will be much lesser, and vice versa. And we also see that the margins also, they go the same way. The margin will be higher with the term to maturity. If the credit quality of the borrower is higher, the margin also will be lesser. When I'm saying margin, we are talking about the haircut. And even if the collateral is more and more credit worthy, the haircut would be much lesser. And even the demand for that collateral, if the demand for a collateral is very high, why is that I'm talking about a demand? See, some lender may very well instigate that they want only treasury bills as the collateral. So the demand for treasury bill as a collateral is much higher. They may not be willing to accept any corporate bond as the collateral. So the demand for treasury bond or treasury bill as a collateral is much higher compared to a corporate bond. So because every lender wants this as a collateral, the demand for it is typically going up, which is very well resulting in the lender being ready to compromise on the margin to provide to have that as the collateral. So that's the reason, if there is a huge demand or less supply associated with that particular collateral, I see that the margins will decrease and vice versa. Similarly, when I am talking about a reverse repo, it is completely the opposite of a repo transaction. Instead of selling a security and borrowing, we are talking about buying a security through the lending process. So these are the various sources of fundings that are available with the for the banks on a short-term basis to meet the day-to-day requirements, right?